Hi everyone, welcome to the pre-watch video on a very interesting concept which is one of my favorites in the entire income statement as a topic. It's known with the name provisioning. Why it's so important and like I said one of my favorites is because the practical application of this particular concept is second to none. There is no one that is looking at this video who hasn't been subject to this concept in their practical life. Let me tell you how. And you are going to be confused that you are perhaps some of you are looking at this concept, listening to this concept for the first time, and how can you be subject to this concept ever? Well, the B school fees that you all have paid is a good seasonable, a reasonable amount. Uh, you won't imagine your parents to arrange for this mammoth amount in just 1 year. How do you think your parents arranged for whatever that number is, 15 lakh, 20 lakh, 10 lakh, different programs, different schools? How do you think a parent who has to, who can see that there is a big outflow coming up, how do you think they arrange for it? The word that we use is the parents have to provide for those expenses. So do you see the word provision coming into your picture? So the fees that got actually paid in 2020 or 2021 or 2019 got paid in a particular year was actually provided for, accumulated thoda thoda, little bit, and then kind of creating that compounding effect over a period of time. So that's where provisioning affect all of you practically. Let's look at in the context of business. Let me remind you that you have already done a concept called as the accrual of expenses. You're aware that the expenses need to be divided between the direct expenses, expenses related to the output, and expenses which are related to the time, which is also sometimes called as the period cost. So, and I'm not going to get into the what is the meaning of both of these, but the matching concept that you had learned while looking at the accrual of direct expenses, and if you also remember carefully, I took provisioning as the name there itself, that in context of warranty or in bad debt, the matching concept give rise to provisioning as an application. So that's what you're going to do here. Let me give you a problem first, and then you would be able to understand what I'm talking about. You understand what is a bad debt? Bad debt typically is a credit sale which the customer, after a point in time, after buying goods, from you and enjoying the credit period over a period of time, they then say no, they can't pay. So it's actually a hard burn. This is actually a bad news for the seller because the future economic benefit resource that the seller was hoping to receive is not going to come now. There could be a willful default, there could be a genuine case, etc., etc. We're not getting into all of that. But should a bad debt or a bad news come in, what does seller have to do? Well, there is no other way, but the account receivable is going to go down, the cash is not going to come in, and this entire amount of non-recovery is going to be taken in the income statement as a loss. It's not an expense, it's a loss. No benefit coming out of it. Now imagine the sale had happened in year one, profits being booked in year one, and profit of year one goes up, performance of year one goes up, everyone is clapping that first year performance was fantastic. And the customer that I'm talking about enjoyed the credit period, which therefore the payment date happened to happen in the second year, the subsequent year. That's when the customer says he or she can't pay. Now, in which case, all the recoverable which would not happen is going to be booked as a loss in the second year. Second year, a huge loss is going to come in. The profits are going to go down. The performance is going to go down, and everyone will think that the business performance went down in the second year. Everyone is going to start curse the second year. But hey, the bad debt happened because the customer to whom you sold was a problem. It's not the time's problem, it's the customer's problem. And the customer was inducted into your life in the first year. So ideally, the entire curse, the entire disadvantage, the entire This negativity towards the second year should ideally be transferred to the first year. But so how can we transfer it to the first year? Because at the time of sale, there was no sign that this customer is going to become bad. Otherwise, we wouldn't have sold it. So out of experience, let's say out of 100 customers that I deal with on credit, I have a sense historically that about 5 don't pay. That means from every sale that I make, 5% is like a rough bad debt provision, bad debt amount. And that's where this provisioning is going to come in. Because here you see that at the time of making the sale, I should have booked a bad debt, but I don't know the amount. So therefore, this is a classic case where the accrual and cash flow don't coincide. The actual bad debt, the actual payment, the actual outflow, the actual loss is going to happen in the second year. But I need to accrue that in the first year because that's a direct expense. That bad debt, that customer, I can directly relate it to the sale that I made on a particular day. This is not a time-based loss. It's a very, very relatable loss. But on that day of making the sale, I wasn't aware of the exact amount. So welcome to the world of provision. Provision is like a expense whose trigger has happened, but I don't know the exact amount for it. So what do? I reduce my profit in the current year itself, and since I don't have to make payment right now, I save that under liabilities. So the heading of liabilities, typically liabilities and provisions. So in terms of A is equal to L plus C, my asset side is not affected. My capital goes down because I'm saving some profit. I am reserving some profit, and my liabilities go up. So that should there be an obligation tomorrow, I can pay the cash and reduce the liability, not impact the P&L of the second year. The problem of P&L for the second year was that the reason for this negativity happened in the first. So by creating a provision in the first year itself, by reducing the profit in the first year itself, I have shifted the burden of negativity to the first year. And by doing this entire exercise, you see that the allocation of profit between the 2 years is also even now. It's not that in the first year there's only positivity, sales, profit, etc., and the later years are going to suffer because of that. That's going to be a bad performance measurement. So provisioning in that sense is a brilliant tool which allows the accrual and cash mismatch to be handled in a very, very seamless, very, very convenient way, and allows the matching concept, getting applied in a direct expense like warranty, like bad debt, and there are many other applications of provision. Okay, in our live class, we're going to talk about how would the financial statement behave if there is no provision. What would be the problem? We have discussed that although, but we are going to use a numerical in our class to quantify that problem. And then we are going to look at the same case with provision and compare the 2 years as to how with provision the performance measurement becomes much better. It becomes much more effective. Yeah, of course, I can guess what you're thinking. At the time of making sale, that 5% historical average and whatever, the number that I spoke about, is it absolutely damn sure that this exact number will be the loss? Answer is a big no. In case the actual loss happens to be 6%, then that extra 1%, what would you do with that? In case the actual loss happens to be 4%, then over provision, you have played conservative. How would you handle that extra provision created of that 1%? That's what we're going to discuss in our live class. So accounting doesn't mean recording transaction once it for all. It means mirroring what is happening on the ground. So if on day 0 I made a sale, I'm going to make a journal entry of my sale. The moment I get a sense that it is a bad news, I'm going to make some kind of a provision. The moment I get a sense that the provisions have been made extra, I can always reverse that transaction. So you can't question me, bind me for an action that I am doing today and complain that my yesterday's action was opposite to it. Because yesterday the ground situation was different. And the last thing before I close this, um, all of that, does it give the accountant a lot of power to change the profits? Answer is yes. That's one of the reasons auditors, any surveillance authority, the valuators, the investors really don't take provisioning with a lot of certainty, with a lot of convenience. They think that provisioning has been used a lot as a tool to manipulate the profit. How? That's what we are going to also look at in our live class. So I'm very, very excited. This remains one of my favorite, topic to discuss in the live class. Just make sure that your A is equal to L plus C. The understanding of that is clear. Expense goes up, so profits come down and capital come down. That's what we have been discussing time and again in concepts of expense. With that knowledge, I'm sure you're going to rock in your live classes. I'm very excited to meet all of you. See you very, very soon. Thanks for watching this.